Hey guys, welcome to Planned Investing. Today I will be talking about the top 3 growth stocks to buy if the market corrects again. Personally, I think these are a must-have in your portfolio with a lot of growth potential ahead of them. The first stock is Facebook, ticker symbol FB. Facebook is an American social media and technology company. Since the Cambridge Analytica privacy scandal in 2018, where Facebook's users' personal data were breached for political advertising, the stock somewhat has underperformed, struggling to break past the $200 mark. However, despite these wrongdoings, Facebook has since vowed to make substantial changes in how it collects and uses personal data, as well as restricting the control and access that external apps have to personal information. The effectiveness of these reforms has in many ways restored user confidence in Facebook, helping to ingrain this scandal as a distant memory. Such changes have therefore helped Facebook overcome any headwinds to it realizing its true growth potential and reassured investors of the underlying strength of the company's business model. Facebook is already growing at an exponential rate, with total revenue having increased by 165% since the end of 2016. On top of this remarkable rate of revenue growth, Facebook is also achieving such impressive growth while maintaining a net profit margin of more than 25%. This ability to grow rapidly and continue to reap high profits makes Facebook stock extremely attractive, allowing them to continuously improve their already immaculate balance sheet. With Facebook already having $54 billion in cash with virtually no debt, this allows them to mitigate any risks from potential competition through new acquisitions and constant innovation in their platforms. Further, with 3 million businesses actively advertising on Facebook, as well as there being close to 3 billion monthly active users across its family apps, Facebook's ad revenue as of Q3 of 2019 was $17.4 billion, an increase of 28% from 2018. Although this number did indeed fall sharply in March as a result of the pandemic, the first few weeks of April did indicate strong stability as businesses start to advertise on the platform again, with lockdown measures beginning to ease worldwide. In addition to this, Facebook's ability to gather information as well as their audience reach allows for more sophisticated advertising than other more traditional streams. This tailored approach, with businesses able to understand their audience analytics and advertise accordingly, will only result in more ad revenue growth on their platform as businesses make the shift from physical to digital, realizing the capability that these social media platforms have in generating traffic to their brands. More importantly, there are also many areas of Facebook's network which are still untapped and could provide additional revenue streams. WhatsApp and Messenger, for example, are areas of the business which are still yet to be monetized. With monthly active users on both platforms totaling to 2.9 billion, such monetization will further add to Facebook's already growing ad revenue. Overall, despite the fact that Facebook may indeed face greater costs as a result of government regulation, their already impressive growth rate and bulletproof balance sheet, in addition to the visible elements of the business which are still untapped revenue streams, makes Facebook an extremely well-placed long-term growth play. The second growth stock to have in your portfolio is Alphabet Inc., ticker symbol GOOGL. Although Alphabet fell around 34% as of the 23rd of March from its all-time highs in February, it has already recouped a lot of its losses, situated only 9.6% from its 52-week high as of the 10th of May. Despite this surge, Alphabet still has much more room for future potential growth. While Google's digital advertising segment did indeed suffer as a result of the pandemic, other components of the business did in fact benefit as a result of social distancing measures and worldwide lockdowns. For example, YouTube generated $4 billion in ad revenue in the first quarter of 2020, up 33% from Q1 of 2019, whilst Google's cloud revenues also rose to $2.78 billion, climbing 52% from the first quarter of 2019. Irrespective of the lack of clarity surrounding current commercial search behaviors, durability, and monetization strength, it is clear that Alphabet's advertising business will recover substantially once the economy begins to stabilize and consumer confidence is once again reinstated. Nonetheless, Google has outperformed other stocks in the market and has been a winner from this pandemic, with many people relying on their services more than ever. It is fair to suggest that Alphabet will come out of this crisis in a stronger position than it entered, with enhanced market share. Separate from this, Alphabet's underlying business model makes them an attractive high-growth long-term play. With Google's search engine having a market share of 87%, this dominance allows them to continue benefiting from high ad revenues. Although their ad revenue growth rate did indeed slow down recently relative to past years, their virtually unopposed monopoly on search worldwide puts them in no risk from competition entering the market and thwarting their profits. Such presence gives them strong potential for future growth. As more advertising moves from TV to online platforms, Google, being the leading player in their field, will be able to capitalize on this shift, allowing for greater ad revenues in the future. Secondly, with a larger proportion of individuals in developing countries being able to acquire low-cost mobile devices with access to internet, this broader exposure to emerging markets will provide a new opportunity for monetization. Google's other smaller revenue streams, such as their cloud services, are equally as attractive, growing at exponential rates relative to other segments of Alphabet's business. This segment of the business will only continue to grow as cloud computing becomes increasingly adopted worldwide. Alphabet's strong balance sheet also adds greater clarity as to why this stock is a must-have in your portfolio. With $120 billion in cash and cash equivalents and only about $4 billion in debt, Alphabet is able to devote a lot of its capital towards investments in research and development, helping to improve the efficiency and quality of their current services, whilst also enabling them to concentrate their efforts on creating new cutting-edge products. Their high net profit margins of 20% over the past 3 years is also a clear indicator of the company's healthy financial position. Such a figure helps to portray the pricing power that Alphabet has due to their market dominance, continuing to grow its revenues without diminishing its margins. Overall, although the pandemic has put a strain on Alphabet's digital advertising revenues and somewhat highlighted their sheer dependence on this segment of the business, their growing diversity as well as their robust financials makes them an appealing long-term investment with the potential to yield some very lucrative returns. Lastly, the third company to have in your portfolio is Microsoft, ticker symbol MSFT. With the rise of cloud computing, Microsoft's Azure is in a very strong position to benefit from this growing trend. In fact, this strength in cloud was indeed highlighted in the first quarter of 2020, with revenues in intelligent cloud increasing by 27% to $10.8 billion. Most notably, Azure's revenue growth grew at an astonishing rate of 59%. The Productivity and Business Processes division also saw strong results in the first quarter of fiscal 2020, with revenues increasing 13% to $11.1 billion. Such growth was driven by a rise in sales in cloud-based office products, both commercial and consumer-based. In addition, LinkedIn revenues also helped drive this sector of revenue growth, increasing by 25%. Microsoft's Azure cloud platform, which allows consumers to deploy, manage, and build applications or services via their data network on a pay-as-you-go plan, is growing at an exponential pace, with revenues having consistently increased at a rate north of 50% every year for the last 5 quarters. Although behind Amazon Web Services, Microsoft's Azure has shown very promising signs of growth over the past years as more businesses and consumers adopt these services, recognizing the practical benefits of cloud computing. However, the growth of this cloud infrastructure does not come consequence-free. With its expansion comes greater costs for Microsoft. For example, capital expenditure in Microsoft's Azure will exceed $15 billion in 2020 relative to 2015, where less than $6 billion were invested. Albeit, such high capital costs to run the infrastructure and constantly expand it are indeed justifiable considering the rate at which it is growing, and most importantly will work in Microsoft's favor. With Microsoft having over $133 billion in cash and cash equivalents, smaller startups specializing in cloud computing will simply be outspent by large corporations with access to magnitudes of cash, therefore leaving this industry to the reserve of a few big players. In addition to the growth of Azure, Microsoft is able to facilitate such expansion with a healthy net profit margin of 33%, giving it a comparative advantage over their cloud computing counterparts such as Amazon, who sacrifice some of their margins in preference of investments to grow more rapidly. Overall, despite Microsoft incurring higher costs as a result of the Azure infrastructure, their consistent revenue growth, strong profits, and access to huge quantities of cash makes them a safe investment with a lot more room for growth. The incredible development of their cloud-based services and products is extremely attractive as cloud computing becomes increasingly used in the long run. I hope you guys have enjoyed this video and found my reasoning behind these choices logical. If you indeed agree with this selection of stocks, make sure to like this video and subscribe to my YouTube channel so you don't miss out on any future content. Don't forget to also comment what other growth stocks you guys would have within your portfolio. Thanks so much for watching.